With an astounding $80 billion in wealth, Warren Buffett is regarded as one of the best investors of all time. If you watch the channel, you already know that we value taking advice from investors like Warren Buffett and Charlie Munger. Their ability to invest in businesses with long-term, sustainable competitive advantages is a major factor in their success. Although Berkshire Hathaway, his corporation, chooses not to pay dividends, a sizable portion of its holdings do. In actuality, the dividend income from his investments exceed $4 billion annually. You might want that for yourself too, but don't fret because we'll tell you how. Hey, welcome to Stock Market Mate. Today we'll tell you how Warren Buffett's enormous cash flow enables him to continuously double his money on a variety of stocks. If you enjoy the video, please like it and subscribe to the channel. If you're done with that, then let's get into today's topic. Warren Buffett and Charlie Munger. Value investing is a term used to describe Warren Buffett. Choosing companies for this investment approach entails looking for ones that are trading below their intrinsic or book value. But as time went on, his plan changed, heavily influenced by Charlie Munger. The Cigar Butt approach. Ben Graham taught me to buy items quantitatively and look around for products that are cheap, and that had a significant impact on me. I then set out to find what I like to refer to as cigar butt of stocks. And the cigar butt method of purchasing stocks is searching the area for cigar butts while strolling down the street. Eventually, you find a cigar that, in all honesty, looks awful, is mushy, and has only one puff left in it. However, you pick it up, take one horrible puff from it, and then throw it away. Though it's free, well, it was inexpensive. Next, you search the area for another stale, one-puff cigarette. I worked in that capacity for many years. It's a mistake because, despite the fact that we profit from it, enormous money isn't necessary to succeed. It's so much simpler to purchase wonderful firms. So now I prefer to pay a fair price for a wonderful business. Given that time is a great business's buddy, you actually want to be in one. You continue to make money as it keeps growing and conducting additional transactions. Investing in See's Candy. Through their investment in See's Candy, they were able to make the move to concentrate on the quality of the underlying business. But because we were always learning, the men we were 5 years ago were less sensible, and See's Candy really did impart a priceless lesson to us both. And if I give you the whole story, it'll teach you a lesson. Warren and I would have left if See's Candy had demanded $100,000 more. That's how stupid we were back then. And one of the reasons we didn't walk was that we were not going to pay any more money while we were making this wonderful choice. We were told by Ira Marshall, "You guys are nuts. There are certain things you should spend money on. You're underestimating quality." So Warren and I should pay attention to the criticism rather than acting in many of the same ways we do. We changed our minds, and anyone can learn a lot from that. Think about the money we made by accepting just one criticism if you have the capacity to receive criticism and use it productively. And if you take into account the side effects from the lessons we gained from purchasing See's, you might claim that Berkshire was partly created by taking advice from criticism. We'll explain why it would have been a bad decision to leave See's Candy right away. For $25 million, they acquired the entire business in 1972. The company generated $31 million in sales that year and after-tax profits of $2.083 million. The company also needs $8 million in working capital to run. Buffett was not willing to pay more than the $25 million he proposed for See's based on his assessment of the company. That would have been a foolish choice to make. As of 2007, See's Candy has generated pre-tax profits for Berkshire Hathaway of $1.35 billion. Additionally, See's generated a pre-tax profit of approximately $82 million on $383 million in sales that year. Therefore, each year Buffett more than triples the amount he initially invested in See's Candy. This made it completely meaningless, whether they paid $100,000, $1 million, or even $10 million more. According to Buffett, See's has generated $2 billion in pre-tax profits in 2019 and is still a cash cow for Berkshire Hathaway. See's Candy is a perfect example of what Buffett values in a company. Through strong brand and client devotion, the company has developed a competitive advantage. According to Buffett, we seek in a business a long-term competitive edge in a stable industry. Great if that results in quick organic growth. However, such a business is profitable even in the absence of organic expansion. This is exactly what he did with See's Candy. He'll just take the lavish profits of the business and utilize them to buy comparable enterprises elsewhere. Although there was little room for growth, the business could guarantee a steady cash flow. All of Buffett's subsequent investments would reflect this concept of making excellent purchases at reasonable costs. Despite the fact that the bulk of his investments generates dividends, Warren Buffett does not particularly target dividend stocks. The business he targets are the cause of this correlation. Dividend stocks are frequently held by mature, high-profitable businesses with tested business models. This closely aligns with Buffett's preferred investment strategies. Approximately $4 billion in dividends are paid out annually by Warren Buffett's Berkshire Hathaway, as was noted at the opening of this video. This sum doesn't even account for profits from businesses they own entirely, such as See's Candy. The Coca-Cola Company. The Coca-Cola Company, which Buffett has owned since 1988, is one of his best-performing dividend stocks. He will receive more than $656 million in dividend income from that investment this year. With a current dividend yield on cost of 50.5%, Buffett has an initial cost basis of $3.245 per share. This indicates that he is increasing his initial investment through dividends alone by more than doubling it every 2 years. For more than 58 years, Coca-Cola has increased its dividend steadily, and there are no signs that this pattern will halt soon. This is a perfect example of a long-term investment in a company with significant advantages. If you're interested in learning more about Coca-Cola, we reviewed the company's entire stock and will include a link in the video's description. Apple Incorporated. Warren Buffett made significant investments in Apple in 2016, and Berkshire Hathaway now controls more than 5.9% of the company. Although he has already seen a sizable return on his investment, we believe that it has potential to become his next Coca-Cola. He expects to get $822 million in dividends this year, the highest amount of all his holdings. Although we don't know his exact cost basis, we may infer from the time he invested that his current yield on cost is between 2 to 2.5%. Apple has a huge following of customers and is currently the most valuable brand in the world. It has also increased dividends for 9 years and has a 5-year compound annual growth rate of 10.5%. If, like Coca-Cola, Buffett doubled his initial investment every 2 years through dividends in 30 years, we wouldn't be at all surprised. We also conducted a full stock evaluation on Apple, and will provide a link in the description if you're interested in reading it. Moody's. Buffett has a variety of dividend stocks with impressive yields on investments. This is made possible by the fact that his investments are made for the long run. The credit rating, risk analysis, and data analytics firm Moody's is another source of revenue for Berkshire Hathaway. It will get over $55 million in dividend income this year. The yearly yield on cost for Berkshire is 22.3%, with an initial cost basis of just $10.05 per share. Buffett receives a dividend payment every 4.5 years that doubles his initial investment. Taking into account that Moody's current trades for roughly $270 and has a dividend return on the cost of 0.8%. American Express. Buffett receives $260 million in annual dividend payments from American Express. The dividend yield on cost for Berkshire Hathaway is 20.3% at an initial cost basis of $8.49 per share. This indicates that with dividends alone, they will double their initial investment in slightly under 5 years. Other prominent investments include Bank of America, which pays $743.7 million in annual dividends, as well as Wells Fargo, which pays $659.3 million. Kraft Heinz with $521 million, $222.5 million for US Bancorp, and JP Morgan Chase with $214.2 million. These are a few of the several dividend-paying stocks in Warren Buffett's portfolio. The key lesson here is that you may earn enormous yields on cost and enormous profits when you invest in businesses with long-term competitive advantages. That's about it for today. If you found this video helpful, kindly click the like and subscribe button. Also, you might want to leave a comment below. We love hearing from you. Thank you for watching, and we'll see you in the next video. If you enjoyed this video, you're going to want to watch one of these 2 videos right here. Enjoy!